Hey Tom,
Hey, how you doing?
good. The time just got by me. I was in the middle of doing stuff, and I'm like, oh, it's already 11:30.
No worries.
Yeah.
So, um, we're gonna go over income tax return analysis. I think that's the plan for today. So, I think the way that we're gonna approach this is I'm gonna go over just basically a blank tax return um, that I just pulled, from the IRS,
Mm.
um, and then each tax return is well, there's we're going to go over business tax returns today as much as we can. Um, there's always just different ways for tax returns to be filed and done, and it really depends on how creative the CPA is, how the borrower really uses their property. So we're kind of just going over like a general high level what to look for. And really the only way to learn this is going to be from experience. You know, just from my experience, the only way to learn from experience. There's no, even though there's like set boxes as to this information goes there. There's just so many different ways to fill these things out and how the CPA wants to do it. So let me share. First, we're going to go over the 1120S, which is what we see the majority of. Let's see.
Also, too, in the future, I'd like to go over the business schedules and the profit and loss and things like that.
Oh yeah.
Yeah.
We're gonna go over the whole shebang eventually, but um, we'll start with this. So you can see the K1 on your screen right now?
Mm-hmm.
Okay.
And is
So
that the same as that's always the 1120S is the
mhm.
K1?
Yep. So this is the 1120S form, S corporation or S corp, and that's what gets associated with the 1120S K1. So um, we'll go over this first, and then we'll get to the K1. Um, so um, and we're going to go over the basics and everything, just so you can, points to look at. I don't know everything about tax returns. I,
Why not?
yeah, there's just a lot of information there. I
Yeah.
know enough to be dangerous, and that's it. So, um, the top bar very similar to the personal tax returns. It's got the name, it's got the EIN number of the corporation or the S corp, name of the business, and what they use for filing taxes, the address that they use for filing taxes. Um, Date incorporated, um, that's going to be the date that they, that's one thing worth looking at. If you've got a lender saying, hey, Lana, go get me those 2017 tax returns, and date incorporated is 2019 or 2018, they're not going to have 2017 tax returns. So that can kind of make you look like you know what you're doing sometimes, and make you look good when you can, you know, just a quick thing to double check, and it saves going back to the borrower and the borrower having to explain it. So good
So
to
the
check.
date incorporated is when the business kind of was
Started. Yep.
started.
Yep.
Yeah.
So that's
Okay.
going to be the date that the business started, and obviously they're not going to file tax returns prior to that.
Right.
So good. That's good to check. The other thing that can get you on tax returns for the dates, um, this up here, this for calendar year 2019 for tax returns beginning blah 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 19, ending blah 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 20. So they can have different fiscal years than the annual year. So if they, it doesn't always happen in this case, but say they started the business in June of 2018, and then they decided to start filing, they started their tax returns June of 2018, and then they ended that fiscal year June of 2019. Those tax returns would be filed on a 2018 tax return, even though it ends in 2019. So that's the other thing to watch, is make sure and not a lot of businesses and corporations do this, but it's just good to make sure that this doesn't have some funky dates in there also, where you could be looking for the 2019 tax returns, but their 2019 tax year might not end until sometime in 2020, which they would not have a 2019 tax return or extension at that point. So that's the kind of the important information to look for up here. Is obviously make sure it's the right business or the right entity name. Make sure EIN numbers kind of tie together. You really don't have to go and double check EIN numbers, but if something doesn't jive, it's good to check, maybe they have two entities with the same name or similar name, and then the date incorporated. So if it's a 2018, 2019, entity, they're not going to have any older tax returns. And then up the top here, just make sure that we're not dealing with an entity that has funky dates, that doesn't go from January to December for their fiscal year. If they go from June, June, July, sort of, or June to May or whatever, it just kind of throws off where the taxes get filed. Again, this top, that doesn't happen too often, but I have seen it before. So just things to be aware of. So then, any questions on that stuff?
No.
Okay. So on this stuff, this is where we start to get into the actual income, where things are being reported. Now, this set of tax returns that I'm using, you can see up at the top here, it's only 5 pages. You can read through here. There's, attached form 1125A, attached form 4797, 4562. Tax returns generally are going to be longer than just 5 forms or 5 pages.
Yeah, I know.
Yeah. So that's, and
I get lost inside of them. I'm like, what?
Yeah. So that's, this is really kind of like the main page that you need to be going to first to find out, what's in there, where are they reporting the income, and what's going on. The main, the quick way that I look at tax returns, typically, to just kind of get a bearing of it, is I honestly go down to the bottom, ordinary business income and loss, and what's the number that's in there, just to see, are they reporting a positive number or a negative number. Just because it's a negative number doesn't mean that they're losing money, because there's a lot of things that can be um, just written off, like, just accounting sort of stuff to use to, depreciation, amortization, things like that. But I look at this, and this tells me what they're reporting as their ordinary business income or loss. Then what I do after that is I scroll through them a bit, and I go to find its schedule. It's M1, and what that is, and looks like we're going to skip over a bunch of stuff, but we're going to go back to it. But basically, schedule M1. Then we go to here, net income and loss per books. So this is actually what they're putting on the books as their net income and loss. That should be pretty similar to that line on the front page of the 1120S, but this is going to have things in there that they can't write off for tax expenses. One example is going to be meals and entertainment. That's one that they can only write off 50% of it. So normally it's not a huge variance, but this is going to be the number that the lenders start with. That's going to be, they're going to go off of per the books. So if they, for example, if it's a business that has a very high expense that they can't write off, like meals and entertainment, they can only use 50% of that expense for a write-off. Well, 100% of that expense goes into here. So this is really the number that's going to matter, is we want to know what's going on the net income and loss per the books. So if I was actually going to go and do a tax analysis, I would just write that number down. That's really my starting point. And that's my starting point because normally when we're doing like the tax analysis, I'm going to go back up to the top here to the front, to the first page. Normally what we're doing is we're concerned about income. We're not really concerned about sales or total income, from the sales, or net gains. We're concerned about cash flow. So we want to see the
Why
cash
does
flow.
it say income and then in parentheses loss? I mean, if it's income, how
Mm.
can it be a loss? So I'm
Well, it's on there as an either or. So
okay.
yeah, so if you
Okay,
have like
gotcha.
gross sales of $1 million, but the cost of goods was 1.2 million, you got
Hmm.
a 0.2 million loss essentially.
Okay.
That's really what it comes down to. So basically, we're concerned as to what the quickest way to get to the cash flow is to figure out what they're reporting on the books as their actual income, and then adding back in the things that are just really balance sheet losses, if that makes sense. So that's the way that we're going to look at getting to the income. But we'll go through the whole thing start to finish. But that's ultimately where we want to be, is figuring out what their actual income is. But we'll start at the top just to get a good understanding of what all these lines are. So gross gross receipts or sales. It kind of just explains what it is. It's self-explanatory. If you've got a business that sells widgets, if you sold $10,000 in widgets, you put $10,000. That's what you made at the register selling those widgets. It's not what it costs you to make them, produce them, and then the difference or anything. That's where that gets calculated out here. So if we've got 10,000 in widget sales, say you've got 10,000 widget sales, and say 1,000 of those were returned. You sold them at the register, but you have a return policy, and $1,000 worth of widgets were returned. That's where this line would go. So that's immediately you've gone from 10,000 to 9,000 in actual income. This is being subtracted out of that. So balance subtract line 1A from 1B, you would have 9,000 in here. Does that make sense?
Mm-hmm.
So that's where gross sales or receipts gets whittled down immediately by returns or allowances. So that's why we're now down to here. This is where cost of goods sold. So attached form 1125. Normally, I mean, since we're starting down here, it allows us to ignore a lot of this stuff in the long run. We really don't, unless we're comparing year after year, and want to get an understanding of why there's a change in cash flow. We're really not looking up here. But cost of goods sold, attached form 1125. That's going to be what was the cost of the widgets. So if if they sold, their $9,000 of widgets, and it cost them $5,000 to purchase those widgets before they sold them, then $5,000 goes in here through 1125, and then they're down to $4,000 in gross profits at that point. Excuse me. Net gain and loss from 4797. And to be honest, I'm not familiar with that form, but that's going to be, it's just a form 4797, that those net gains or losses would come onto this form. I'm not particularly familiar with that form, just being honest, because not something that we really need to dive deep into. Other income or loss, see attached statement. You'll see attached statement pops up several times in the tax returns. You can see it here. Other deductions, see attached statement. Basically, this is kind of a catch-all. Other income or loss. best example I can think of on this is if you've got a gas station that sells lottery tickets and somebody wins the lottery and they get their cut from the lottery winnings, they would report other income as they would report that as other income, and it would go on a statement. Now, that's when you get into the on the tax returns, on the business tax returns, when you scroll past the the first pages of it, and you start seeing like, and it depends on how they want to do it. If they want to do statement like A, B, C, statement 1, 2, 3, either way, it's going to be at the end, and it's the accountant breaks each section down, as statement A, other income, or statement 2, statement 1, other income, and then it's going to have a list of lottery winnings, lottery paybacks, whatever that amount was, and then after that, whatever other income it was, that translates on there, and that all gets added into there. So then we get down to total income or loss. That's basically all these sections up above added together to show what was the total income or loss. Hopefully it's income, but this is really just income generated by the business, from costs, from sales of whatever their product is, minus returns, minus cost to produce that product, and that, or cost of goods sold, not really cost to produce, but cost of goods sold, and that's the amount that's left over. So this information is good for trending, really, if you want to see what's going on with the business as far as trending. You can look at the top, and if you're comparing this ordinary business income or loss, or off of the M1, if you're seeing that's going down year after year, it's good to look up at the top and say, okay, is it going down because these numbers are going down, or these numbers going up? So it could be a case of you've got, the total income is going up, but then this lower section is going up also, which is bringing the income down, because these are the expenses or additional deductions. So not something that you really need to be, digging too deep into or worrying about, but just good to understand. This is kind of, the top part is the income section. Now this bottom section is really expenses. Even though we do have some expenses in here, this is really, just cost of goods, but the rest of the expenses go into here. So on this lower section, these are the items that we try to add back in to the ordinary business income or loss if we can. Now, that doesn't always work out. Some of these deductions are clear, accurate deductions that are cost of doing business. First one here, compensation to officers. Now, compensation to officers is basically, think of it as like a salary paid to anybody who has a W-2 or a percent owner, or I'm sorry, a K1 or a percent owner in the business. So compensation to officers, this is now we're looking at the K1. So on the K1, anybody who has a percent ownership in the business, compensation to officers normally does not show up on a K1. It's paid on a W-2, but it's a W-2 that gets paid to the officers. So you don't see it a whole lot, but it is used. So that would be like a salary paid to the business owner. This section here, salaries and wages, less employee credits, that's salaries and wages paid to employees. So that's W-2s to employees. Those two generally, they are what they are. They're not going to be added back in. It's expenses for the business. This generally, gets captured in a cash flow for the what's called the global cash flow, not the business specific, which is what we're looking at here, but the global overall global cash flow. It gets counted into the guarantor or the borrower's cash flow essentially. But we're just looking at what the business is specifically doing here. So next line, this is something that to be aware of: repairs and maintenance. This is something where accountants can get tricky on. I've seen before. Repairs and maintenance is any repairs to. Typically, it's supposed to be repairs to business built to commercial buildings. It could be repairs to equipment. It could be, maintenance equipment, vehicles, things like that. I think typically those show up in a other section. Normally, this is business repairs, but they'll sometimes, lump in capital expenditures or improvements to buildings on repairs and maintenance. So say the borrower doesn't actually have a repair or a maintenance, but they want to report improvements that they've done to a building. We'll see that on a lot of times multifamily properties will have improvements they're going through and they're renovating each unit. They'll put that as repairs and maintenance. So you might find that if we've got a downward trend, the current year is lower in income in the ordinary business income and loss, but the upper section here is similar across the board. Each year they've been consistently making say $1 million in total income, but down here there's a big dip. It could be because they had a huge repair that they had to do in one year. So that's something that could potentially be non-reoccurring income. So if we should be cash flowing these before they go to the lenders, but just so you're aware, if the lender comes back and says, hey, sorry, this deal's getting declined because the income's too low in 2019, 2020, and you ask them, hey, go over the income with me, that's sort of stuff if there's a huge jump in repairs and maintenance, be aware of it. That's something where we might be able to go back to the borrower and say, hey, Mr. Borrower, explain that to me. Why is there a huge jump in repair and maintenance? Is that something that's ongoing, just a one-off? Because lenders can add that line back in if it's a one-off and we can show it and basically bring our income. You bring our income back up. You could essentially save a deal that way by adding in like a line that's like a one-off expense. Does that make sense on it?
Yeah.
Okay.
Yeah.
Next line here is a similar situation: bad debts. You don't see that a lot of times. It's not a line that gets used often, but this is bad debts. It's basically if our client lent money and it didn't get repaid is a bad debt, and they've gone and they've done a 1099 to the whoever they lent money to, they would report that as a loss on their side. So whenever a bank writes off a debt, if the bank can't collect on a debt and they write it off, they 1099 the borrower. So the borrower essentially has to report that as income. Well, the bank has to report that as a loss. So that's where this line goes. Bad debts can sometimes be accounts receivable. I've seen it used for accounts receivable before. If somebody's given up on an account receivable, they could put it as a bad debt, and it's an expense. So you might have one year where the client had an account receivable or some sort of bad debt. They lent money, and they gave up on it. That could impact the income if it's a one-time event, which potentially could be. It's something we can explore adding back in. So those two are important lines to just be aware of. Potential one-time events is really what that's important for. So this this next one here, rents. This can be rents for anything. So it could be building rent. It could be rent for equipment. Um, it could be, you know, one-time rent for, you know, if we have a client that needed a piece of a machinery for our project, and they had to rent it. That could be, the one-time rent goes in here. Um, it can also go into other expenses, you know, for equipment rentals. Um, but I've seen it used here for commercial real estate rent or property rent or equipment rent. So this line's important because if we have a client that's purchasing a building, and they're buying the building, and their loan payment will be, let's just say, 10,000 a month, and on this rent line they're showing that they're currently renting, their current rent expense for the year is $120,000. That means that basically the loan that we're getting for them to purchase this building essentially matches what their expense for the rent on the building is. Now we need to verify it and make sure we have a copy of the current lease, for the building they're currently in. But that's a potential add back, something that can be added back in. If they're purchasing a building to move into and they're currently leasing a building, their building, this rent line should be added back in. And normally, in a lot of cases, it's pretty close to what they're paying. If they're buying if they need to buy a building, they're essentially, in most cases, renting something of similar equal size, and the rent payments are similar or equal. Doesn't always work that way. We'll find clients that need to double the size of the building they're in, and obviously larger building, and you're not adding back quite the full loan amount. But it's something to be aware of. If the lender is saying, hey, sorry, cash flow died on this one, and they're buying a building, find out and make sure, are you adding back in the rent expense? It's going to be important, to make sure the cash flow is going correctly. Next line, taxes and licenses. That's normally reserved for property tax goes in there a lot of times, but it's really any taxes they're paying or any license fees they're paying. Normally not a lot of add back on that, just because of the fact that if they're renting a building, they're not paying taxes on it, or if they are, they're paying it through the rent. But they're not really paying taxes, for property taxes. But it's something to be aware of. That's licenses. It's annual licenses um, for whatever business they're in, if they have to pay annual licenses. If there's like a jump in it, a large increase, just obviously be aware, ask the questions, but normally not a lot that we can do or to add back on taxes and licenses, unless they've sold a property. That's one time that could potentially pop up, if we're dealing with a client that sold a property with high taxes. Any questions on that one?
Mm-mm.
Okay. So next line is going to be interest. That is one that we need to make sure is being added back in most cases if they're doing a refinance. So interest is really any interest that they're paying out. But if it's a business that's paying interest on an existing property loan, if we're paying off that loan, they're not going to be paying that interest anymore. So we need that interest added back into the calculation. And they're going to be paying interest obviously on the new loan, but they get hit on the expense side when they're cash flowing it. So since they're not going to be paying this anymore, it gets thrown back in. It should be included as actual income going forward if they're paying off the loan, because when it comes down to it, it's going to go back into this ordinary business income and loss, and then when the lender does their calculation of how much actual ordinary business income and loss, they're going to kind of compare it against the new loan payment, which is going to include the new interest payment. Does that make sense?
Mm-hmm.
Okay. So next line here, depreciation, not claimed on 1125, blah, blah, blah. You know, this, the 1125A and the 4562, those aren't always included. If you see them and there's depreciation claimed on there, I can't, honestly, I don't think I've seen that before. I always see depreciation included on here. But depreciation is just a loss in value of something. Do you understand the concept of depreciation and how it works?
Mm-hmm.
Okay.
Yeah.
So I'll just go over it quickly, just for future reference on the recording. But when you buy a car and you drive it off the lot, obviously it depreciates in value the moment you drive it off the lot. That depreciation is considered a loss. It's not a monetary loss, but it's a loss. There's less value in the item that you purchase. So, equipment depreciates, buildings depreciate, automotive, cars, fleet vehicles depreciate. That gets added in here. This is a big one and I'd be surprised if a lender ever missed adding depreciation in. But it's good to just be aware of it. That should be added back in. It's just an accounting. It's not actual loss of money. Depletion, you don't see that a whole lot, but I have seen depletion before. It's kind of like similar to a depreciation scenario where it's just an accounting loss. It's not an actual monetary loss, but it's similar. But normally it's depreciation that we see. Any questions on either of those, or are you good on depletion?
I'm good. Yeah, I'm good. Mm-hmm.
Okay. And then the other one that we'll talk about is going to be amortization. That we'll cover in the other deduction section, but it's very similar. Advertising, just kind of as it states, advertising expense. That is what it is. That's not going to be added back in. Pension, profit sharing plans. That again, it's a real loss. It's a real expense that's going to be included on there. Employee benefit programs, again, another expense that's going to be added on there. That's a true expense. Other deductions, see or attached statement. This is anytime you see other deductions, you're going to want to find that statement and review it. That other deductions is a catch-all for everything and anything. Things to note on there are amortization. That's one that's similar to a balance sheet loss. It's not a monetary loss. It's similar to a depletion. Amortization can be added back in. But you'll also find that that's where people get creative. There can be equipment rental. If it doesn't get caught here, equipment rental could go in there if it's a one-time equipment rental. That could potentially be on there. I'm trying to think of other good things to watch for. Depreciation, I have caught that on other deductions before, and I don't know the reason why they weren't claiming it through regular depreciation, but I have seen it on there before. Meals and entertainment would go in there in some cases. That's nothing that we can really add back, but it's just good to be aware of. If it's on there, if it's a high expense, is it something that's trending up, trending down? What's going on with that? Travel, if there was a lot of travel for 1 year, if they started a new project, and they had to travel a lot for that particular project, but that's died down now. It's just something to be aware of. That would be on other deductions. So really what you're doing is you're kind of taking all of these items that you can add back in, and then you're taking this ordinary business income or loss, but you want to take it from this section down here, the net income, and you're going to add those amounts back in to that number. And that's going to give you what the actual income is for the business. So really the goal is to take the reported income, add back in the balance sheet items, the just the paper items that aren't real money, like depreciation, depletion, amortization, and then kick out the one-time expenses. That could just be, if there was just one-time repair or maintenance. Sometimes, there is a legitimate ongoing repair maintenance, but that gets, kick those out. And then if it's purchasing a new building, make sure that the existing rent payment, which would be going away, gets added back in. And that kind of shows you where the cash flow is before the new loan is going to be added in. Does that make sense?
Yes.
Okay. So that's that's really what you're looking at on the tax returns for this page. There's a lot of this other sections to the tax returns. It's a lot of just good, useful information. Honestly, I don't look at it. I don't understand it. Just being honest and upfront, because it gets used differently, and it doesn't really pertain to the cash flow portion of it. But the next section that's good to be aware of on tax returns is going to be here. This is basically the balance sheet from beginning of the year to the end of the year. And basically it's going to, it's reporting a change over the year. So it's going to show, at the start of the year, how much cash that they have. At the end of the year, how much cash they have. So that's, some of these lines are just worth checking out just to make sure that there's nothing that's going to, this is stuff that we should be looking over up front. But it's just good to be aware of it and understand kind of what's there and what's going on. The lines that are important to look at would be cash. It's did they, is there a huge drop in cash? Trade notes, accounts receivable. Is this something that, if they have if they claim that, oh yeah, we've got a lot of accounts receivable, and they have 50,000 in accounts receivable at the beginning of the year, at the end of the year they have zero. It's like, well, you really don't. Why? Why does it drop? The other one that's on here, mortgage and real estate loans is important. Well, let's say loans to shareholders. If the loans to shareholders is increasing, that's money that's coming out of the entity, and it's basically obligations that the shareholders owe to the business. So just something to be aware of. Not always a bad thing, but just be aware of it. Mortgage and real estate loans. If this goes up a considerable amount from the start of the year to the end of the year, it could indicate they bought something that year. If it goes down, it could indicate they sold something. So just things to be aware of there. Again, buildings and other depreciable assets, if that's changes, that indicates something was sold. It's kind of just a lot of where were they at the start of the year, where are they at the end of the year. And then the other one, I think those are kind of the more important ones to look for, is the assets, and the mortgages, just to see what's going on. And then here it is again, liabilities and shareholders' equity, and this is assets. But it's just worth looking over. If something's just jumping out that is a huge change, it's a reason to ask questions, because the underwriters are going to look at it and ask questions too. So just things to be aware of, but not necessarily part of your process, but just good things to be aware of. You know, especially if the you know, the bank comes back and says, you know, this loan's being declined because you know, it looks like they've got, you know, I'm trying to think of an example where it's too many, you know, if they have like mortgage debts or whatnot, you know, mortgage debts, and they're, you know, not sure, you know, if we need to include all of those. If you see that the mortgage and real estate loans has dropped or disappeared down to zero, you know, it might be, well, let's hold off on before we do that. Let's talk to the client and find out what's going on there. You know, or vice versa. If they're saying the mortgage debts have increased, and we can see it on the tax return here on the balance sheet that, yep, it went up from the start to the end of the year. You know, that's something where it's like, okay, Mr. Borrower, what, you know, did you not let us know that you bought something last year? Does that make sense?
Mm-hmm.
Okay. And then, oh, I have to click my, and then so this is the other part of the 1120 form, is the K1. This is a form that's actually part of the 1120s. It's not part of the personal tax returns, it's part of the business tax returns. So if you get the lender asking you for the K1s, check through the filed 1120s first and see if the K1 forms are in there. The K1 forms are basically whoever owns the business is really what it comes down to. It's, think of it like a W-2 for somebody who owns the business. And it's going to include, you know, up top, it's going to include the entity that filed the K1. And then down below, it's going to show, you know, who is getting, who is the owner of the entity. In some cases, that could be an individual. In some cases, it could be another entity. So
Then what if it's another entity? You have
so
to
if
then look at those taxes, or
yep, and it depends. In some cases, so if we have a borrower, let me think of a way to explain this. So if, say, this entity, we've got a tax return for a business that is owned by Bob, and Bob as an individual owns 50% of that entity, and then the other half is owned by, let's call it, you know, so Bob the individual owns 50%, the other 50% is owned by um, Jane's Building LLC. So, and Jane's Building LLC may file a tax return, or if say Jane is 100% owner of Jane's LLC, Jane's Building LLC, Jane's Building LLC may be just a passive entity and does not file tax returns. So whenever you see an entity that owns a business, you know, Bob's going to have to report 50% on his tax returns. Jane's is going to report the other 50%. She may report it on her personal tax returns, or she may report it on the entity tax returns. It really depends on how they have it set up. And you won't know unless you ask. So anytime that there's somebody that's a 20% owner of a building, of a entity, and it's an entity, you need to ask the question, who owns that entity? How does it file tax returns? Does it file tax returns? You're just not going to know unless you ask the questions, really, is what it comes down to. If an entity pays another entity and somebody is 100% owner of that entity, they don't need to file tax returns. They can report it on their personal tax returns, is the best way to say it. Does that make sense?
Hmm.
That one's kind of it's kind of a tricky one, and I can show you some examples offline of where we've run into that before. But because I've got some examples that I can show you on that one.
Okay.
But it's, yeah, basically, if you, it basically kind of falls under, it gets reported. It's kind of similar to having like I'm trying to think of like a C corp, where you just report that income on your personal tax returns. If you've ever seen like the Schedule C on a personal tax return, it essentially gets reported that way, if that makes sense. So we can, that one's kind of a unique situation, but we can go into it deeper. But basically, just be aware if you've got an entity on here as the owner, and their ownership is 20% or more, we need to start asking, hey, who owns that entity? Who are the members of that entity? And does that entity file a tax return? If they come back and they say that entity does not file a tax return and Jane is 100% owner of it, then okay, we need to see Jane's tax returns. That's what it comes down to. If
Mhm.
they come back and they say, well, that entity is owned, and it kind of gets watered down more and more. If they say, well, Jane owns 50% of that entity, and Jane's sister owns the other 50%. Well, okay, at that point, because you've got two owners on that entity, it's going to file a tax return, or it should, and we're going to need to see the tax return for that entity. But again, everybody does tax returns differently. There's going
No
to be some
kidding.
weird occurrence where they still don't file, a tax return for that. Um, so just always ask the question. That's the best way to handle these, is ask the question. And if the client says, I don't know, then at that point we need to say, hey, well, can we talk to your CPA and have him explain it to us? So that's ultimately the CPA is the one that filed it, and he's going to know the answers to how he did it and why. But
Right.
high level, whenever it's 20% owner on or more, if it's an individual, ask for their tax returns, or that we will need their tax returns most likely. If it's an entity, ask the questions: does the entity file tax returns? Who owns the entity? And once we get the entity tax returns, we're going to have the entity's K1s, and we're going to see who owns the entity. So, eventually we'll figure it out and find out, but it's easier if we can just get the information up front, and, the client can tell
Right.
us. But
Yep.
the check and balance on that is going to be the entity tax returns will ultimately tell us who owns the entity. So we'll go through the rest of this little section here quickly. The K1, like I said, it's like a W-2 for the business owner, and off to the side, it reports the income that was paid or earned to the individual. So if it shows ordinary income, or ordinary business income, and if he's a 50% owner and the business made, say, 100,000, he should see 50,000 here. He basically is really the way it goes. 50%. He's 50% owner. He reports 50% of the income. So this really transfers from like that front main page. Now, one form that we didn't cover because it's not part of the standard 1120 tax returns is net rental income. Sometimes you'll see, if two people own a rental property, they'll report it on the 1120S, but they will report it as rental income. And there's a form that looks very similar to a individually owned rental form. And actually, I think it might actually be the same form. But that, basically, this would show you that, okay, there's rental income in here. So if you have a K1 and you see on there that there's no ordinary business income or loss, but they are reporting net rental income, you should go back through the 1120 form and look through it and make sure that it won't be any of these forms. It's an additional form. I can pull it up and send it to you offline, but it's basically a form that's used for reporting rental income on a property. And it's very similar to like a Schedule E rental form, and I can't remember the exact name of it. it's but it basically gives like the breakdown of rental income, property expenses, and things like that. So if you and this is all left blank when it's just a rental property essentially. So just watch out for that. If it's net rental income, make sure we have the correct form in the tax returns that shows the rental income. Those are the two main ones we'll see. Other net rental income loss, I don't have a good example as to where that would show up because I don't think I've ever seen that. Interest income, that's going to be situations where you have clients that are lending money and they're generating income. And then kind of going forward, it's kind of the same. If you've got ordinary dividends, qualified dividends, it's going to be a situation where if it's a entity that's invested in something and that's getting paid dividends, that's where this would get reported. Royalties, if it's making royalty income, you don't see that a whole lot, but it's out there. Net short-term capital gains, net long-term capital gains. So that's from buying and selling of properties or buying and selling of stocks. These sections here, I'm not too familiar with. I don't think I've seen those, or if I have, I not too familiar with it. Just being upfront and honest. Other income and loss, again, a catch-all for anything else that doesn't kind of fall into this. I think, yeah, that's most of the stuff was, foreign transactions, don't see that a lot. These other items we really don't see a whole lot of. But these are the two that we'll normally see, is these two up here. If it's a business selling widgets, or if it's a business that's holding a property and renting it to others, you'll see it in here. And that should transfer to the borrower's personal tax returns. And that might be something we go over in the coming weeks as we're getting close to 12:30 here. But do you have any questions on the K1?
No, that's a pretty good explanation of all. I'll probably run through it again. This is going to be on the training, right?
Yeah, Dave will upload this to the
Yeah.
training, so you can
Yeah, I'll
watch it
probably
again.
watch it again
Yeah.
and make notes,
Yeah.
I'll probably print out an actual form and just kind of make notes and then pull maybe some taxes and just see, identify the different things that you've explained.
Yeah.
So just to help me to really take it in and,
Yep. And each one of these is going to be different just depending on how it's the same general theme and whatnot, but they're going to be different depending on how the accountant runs it, how if you've got multiple owners on a business, they're going to report it and do it different ways. It's just, this is really kind of like high level, kind of what to expect, if that makes sense.
Right. And that way too, when I do that, go through it again, make my notes and stuff. If I have questions, that way I can, ask them in the trainings, over them. So.
The one thing that probably should point out on the K1s that's important up here, these two check boxes, final K1 and amended K1. Now, if you have a checkbox where it's final K1, then that means that basically that's the final K1. they're not they're done with that business. Yeah. So if you run into that situation, and they provide you a final K1, that the lender most likely is going to look at that and question it. I have seen situations where they mark it as a final K1 in error, or they do a final K1 and it's like, just kidding, we're going to continue this business, but just be aware of it.
Probably misread it too, like, yes, this is the final, this is the one and only, the one that we're filing, that's what I kind of first took it as.
Yeah, but yeah, the way it actually is basically this business is done. Like there's not going to be a 2020 K1 for this It's
Okay.
over. So if they're providing you, if they're trying to use 2020 profit and loss, and claiming that this business is ongoing, that's going to give the lender some concern as to why is that marked a final K1. So, but on the flip side, if you've got the 2017 K1 and you might have a borrower that has a lot of entities, and you have the bank going, well, get me that 2018 and 2019 K1, you can point out, well, 2017 is a final K1. This business is no longer around. So, just something to watch for. So,
okay. And what about the amended?
Amended, just as it is, it just means that it's an amended K1. So if you've got an amended K1, you should have an amended tax return. But if it's not marked, I honestly, I don't think I've ever seen an example of an amended K1. But just be aware of it. If there is an amended K1, make sure that what was the amendment. Just something to note and be aware of. But
okay.
Not something that will pop up often. It's that final K1 when you have the client that normally it's the client that invests in a lot of businesses. Maybe has a bunch of small little projects. Sometimes it's the clients that buy real estate under multiple business entities and sells the businesses or the properties. Those are the ones where you'll have multiple. We'll run into it. I'm sure you've seen it before, where you have the guy with 20 K1s, and it's just a headache trying to figure out what do you need for this year. Just it's good when you're reviewing the K1s. What was if there's a final, that you can stop hounding him for the 2018 K1 for that one because it doesn't exist if 2017 was the final.
Correct. Yeah, makes sense.
Cool.
Alrighty.
Well,
thank you, sir.
Concludes our high level 1120S.
Sounds high level.
Yeah. And again, like when you come across them, ask questions. And I can send you some examples of what I was trying to explain, where you may have a situation where the entity doesn't file a tax return and it's 100% owned by an individual. And it just it kind of just stops there. But in most cases, if it's an entity, ask the questions and find out. So.
Okay.
Cool.
Good. Yes.
Alrighty. Thank you, Lana.
Thank you very much. I appreciate it.
Thanks.
All right.
Bye.
Bye.